Congressional cuts to spending and the S&P warning on U.S. debt that shocked the market on Monday could end up hurting state and municipal credit ratings. That's according to a new report from Janney Montgomery Scott, which says there is a clear connection between the federal government's credit and that of the states and smaller governments. Investors have been leaving the muni market in droves, withdrawing $31 billion since November the 10th. Joining us for his take on the muni market is the CEO of Cutwater Asset Management, Cliff Corso. Cliff, it's great to have you back on the show.
It's glad to be here.
Kind of a 1-2 punch here, right? Yeah. You want to see some form of austerity at the federal level, but that's going to hurt the smaller governments.
Sure, and I think S&P is, although it shocked the market, it really is telling us what I think we all know, and that is we have to get our fiscal house in order, not only at the federal level, but also at the state and local levels. And I think that's right. It's a 1-2 punch in that the federal level, at the federal level, we have to cut back, and there's going to be a trickle-down effect that will impact in a negative way the entities down below the federal government, local municipalities, state, cities, counties, and the like.
And to put a number on that, according to this Janney Montgomery report, cities and local governments will lose at least $3 billion in funds for housing, community redevelopment, all those projects under the budget agreement that just concluded. That's not looking at the cuts that we're expecting to come down the pike. So who is going to get hit the hardest here?
I think it is going to be the smaller municipalities that will get hit the hardest. That $3 billion figure is quite a large figure, but I think the cutting is going to be much deeper than that over the next couple of years. The number I think I recall in terms of what the federal government supplied to the states and local municipalities was something like a $200 billion figure, and that's running out. That was part of the temporary support over the last couple of years. So there's going to be some big numbers that are going to need to be dealt with in terms of cutbacks.
So how are you investing along that thesis?
Sure. We think at the federal level, and what I mean by that, state GOs, we actually are very general obligation bonds, very constructive in that sector of the market. Although they are going to have difficulties in cutting back and being tighter-fisted in their situations, if you look at the debt to GDP for the various states, it's really on the order of somewhere about 16–17%. And so there was a lot of fear in the fall and throughout the beginning of the year. That kind of debt level is doable in terms of cutbacks. So we like that sector.
What do you think about California? Because their credit default spreads have really widened out here. There's real worry there. So is that a state that you would be avoiding?
Not necessarily. I think it depends upon what the price of those bonds are. It's been a wild ride in California. Spreads have gone as low as 300 basis points over treasuries to 500 plus. It's kind of on the snugger side right now. California's not going to issue any debt. There's a potential supply squeeze coming in California.
They're waiting until some sort of agreement.
They're waiting until an agreement. So we think actually California's pretty attractive, particularly if it begins to widen out in terms of those spreads.
So we had already been talking to you months ago about this crisis to come in the municipal bond market. And even at that time, you're talking about really the project-specific obligations being worrisome, not really the states. So has there really been a sea change? That $31 billion we were talking about in withdrawals seems substantial.
It is very substantial, and the headlines have made it even more substantial in that there's not a lot of liquidity in that market right now. That's one of the themes that's evolved.
Because issuance is down?
Exactly right. Issuance is down. There's no real price discovery in the market, and the dealers are therefore a little bit more shy in terms of making markets. That has been one of the themes. But I would tell you that this big supply fear a few months back that people were worried about, particularly in the long end of the market.
Meredith Whitney and her call made so many very worried about that.
Yes, it hasn't shown up yet.
Do you believe it will?
I don't think it's going to show up as forcefully as the market fears around the possibility. We're off almost 50% in the first quarter on debt issuance. If you listen to various states and municipalities, they're talking about not issuing as much debt.
Right.
For a couple of reasons. One, they have to get their fiscal house in order, as we just said. And secondly, rates in the long end in particular are kind of high still.
So maybe, they're avoiding it. Maybe they're regaining some control or getting there.
I would say that's the case.
All right. Thank you so much, Cliff, for joining us and giving us your read.